today is benefits of investing in short-term rentals. And this is a very, very important topic because most people are aware of the benefits of owning real estate and investing in real estate, but they really don't understand how those benefits are actually working in the background and what they can do for you as an investor, as a owner. So what I want to do is really highlight some key areas and share with you some details of why short-term rentals are important and why you should be considering them if you're not already doing so. And to introduce myself to you guys that don't know me, my name is Demel Nelson. I'm the owner founder of Nelson and Associates, and we're a firm that specializes in accounting, tax, and tax advisory services. And one of our specialties, and primarily our biggest specialty, is in the real estate space. So for those of you that are real estate investors, that are owners of real estate, this is certainly a very important topic for you. So to get straight into it, I mentioned the topic of the conversation is benefits of investing in short-term rentals. And just to make clear what a short-term rental is, a short-term rental is a rental in which you are leasing it out to a prospective tenant or a tenant for a short-term period. And this is not your standard long-term lease per se. This is not your situation in which you are purchasing an investment property and then you rent it out to someone for a 6-month period at a time, a year at a time, or longer. Rather, what you're doing is you're purchasing this investment property, or you're classifying this investment property as short-term in the sense that it is only for the purposes of short-term periods. And this is an example of potentially using it for the purposes of an Airbnb, VRBO, Expedia bookings. This is an example of what a short-term rental is. And the benefit of this is exactly what I'm actually going to be discussing and getting into today. So before I actually get into the specifics of why these are really important, I think it's important for us to first understand what a real estate professional status is. And when it comes to the IRS, they actually classify the income that we generate and make as either passive or non-passive. And if the income is to be considered passive, this is in effect income that we generate without necessarily materially participating in. And because of that, we have to be clear as to what the income that we generate is classified as. It's either going to be classified as passive or non-passive. And this is really, really important because if you have passive income, the IRS doesn't want you to offset any of your losses from the passive activity against the income from your non-passive activity, which for most people is their W-2 or their 1099 income. So in order to really understand the conversation that we're going to have today, it's really important to understand the concept of REPS, passive income, and non-passive income. And when I say REPS, I'm actually using the acronym in short for real estate professional status. And for the individuals that are considered real estate professionals, these are individuals that meet 3 criteria per the IRS. And if these individuals can meet these criteria, what this allows them to do is then take any of their real estate investments and they can identify any losses from those activities and offset that against their non-passive income. And that is really important because ultimately, if you have multiple investments or real estate investments that have losses, you can now take those losses to offset against W-2 and 1099. So traditionally speaking, if you are an individual that is considered a REP or have REP status, you ultimately are benefiting the most from having real estate and taking those losses to offset against non-passive income, which ultimately is going to reduce your taxes. So the key thing about a REP situation is it, again, requires that you meet 3 criteria. And the benefit of having a short-term rental is that you can actually take the full advantages of a REP status, but not be classified as a REP. And if you're a high income earner, or if you're a person that has a W-2 job or a 1099 sourced income, and you also are a real estate investor, but you don't qualify for the REPS, you can still take advantage of the REPS benefits by way of short-term rentals. So let me talk a little bit about what these three requirements are for REPS. And again, if you qualify as a REP, you're in a position where you can take your non-passive income and offset it against your passive income. And if you have passive losses, those passive losses can offset your non-passive income, which is how you're able to reduce your tax liability. So in order to qualify for the REP status, there's three main criteria. You pretty much need to be able to support and document that you've worked at least 750 hours in the space of real estate. And this is easier for those that are real estate investors, that also are real estate brokers, managers. If you can document and prove that you've worked 750 hours in this particular field or space, that meets one of the criteria. The second criteria is that 50% or more of your time developed or committed to working is in the real estate space. If you have another job or another career that you're involved with and it is occupying more than 50% of your time, then chances are you're not going to qualify for the REP status. And then the third situation or criteria is that you have to materially participate in a real estate trade or business. And the first two criteria being the 750 hours and the 50% or more of the time is not just enough. In addition to that, you have to materially participate. And materially participate ultimately means that the majority of your time is spent here in this space on that particular property or on that particular portfolio, and that no one else is working more than you on that. So those are the three criteria. And because those three criteria are pretty straightforward, it gives us a clear baseline as to whether or not someone can qualify. And even though these are three straightforward criteria, they're really difficult to achieve and accomplish for the average person. The average person ultimately is not in a position where they work 100% of their time or more than 50% of their time in the real estate space. They may have other ventures, other investments, other opportunities that they pursue. So that makes it very, very difficult for them to achieve the status. However, we have a saving grace. And that saving grace is the fact that we can explore the short-term rental opportunity and still take the same advantages, but without having to meet the REP status. And the short-term opportunity is very, very huge because it's a loophole that is essentially giving us the same benefits, but we don't have to go the REP status. We can actually go the short-term route status. So one thing that I do want to say about the REP status is there's people that are confused and they make the mistake of looking at the three criteria, and they may make a mistake in that they miscalculate their hours incorrectly, or they misclassify their hours, or they don't properly document the activity to support the case that they qualify for the REP status. And when it comes to the REP status, it again requires that you materially participate. And you don't necessarily have to go out and get a degree or get a certificate in real estate studies or become a real estate broker or agent, but it just means that you have to spend the majority of your time in that space. And one of the challenges is that some individuals that try to achieve this REP status is that they may document that they've worked the 750 hours or 50%, but they may not materially participate. And what I mean by materially participate is that they are the ones that are working the most on that particular investment, or they're the ones that are working the most on their particular portfolio. So if you have other individuals that are handling the day-to-day opportunity or the day-to-day work, then chances are you're not materially participating according to the IRS. So those are, that's one example. Another example of a mistake when it comes to claiming reps is counting hours. I mentioned there's 750 hours that you have to keep track of. Some individuals will misclassify those hours and count hours that are not eligible to be included in that 750. And an example of that is individuals considering their education and research on particular investments in properties. They count that towards their hours. That's not allowed. They also may count their bookkeeping or working on their accounting towards their hours. That's not allowed. Filing their tax returns, that's not allowed. Managing the actual property manager who's actually the one that's materially participating on that project or investment, that's not allowed towards your 750 hours. So these are some things that are very tricky, and it's important to really understand what qualifies and disqualifies you for counting those 750 hours. So another catch up that I see happen sometimes is that an investor may own several different properties. And if they own several different properties, they may qualify for rep on one property, and they may try to take that qualification and apply it to the other properties. Unfortunately, you have to take each individual property and meet the 3 criteria individually. You can't necessarily just take one property of 5 properties that you own and say you qualify for rep status on one property and apply it to the other 4. You actually have to take each individual property to determine your qualification for rep status. So those are some common mistakes. And as I mentioned, there's 3 criteria, but the 3 criteria are pretty difficult to achieve unless you're very intentional and understand how these rules really work. And certainly if you have another job or another career, chances are you're not going to qualify. So generally speaking, the rep status is a huge benefit, but it's not easy for everyone to qualify for. And one thing that I will say about the rep status, if you do have a real estate investment property and you've outsourced that work to a management company that's actually managing the day-to-day activity, working directly with the tenants, chances are that's going to automatically exclude you from claiming rep status. So the idea is that you are the one that are materially involved and participating in the actual investment project. So now that you understand the issue of reps and how it's a huge benefit to have that status, as I mentioned, if you cannot meet that, then your other alternative is to pursue a short-term rental and identify a short-term rental as a potential investment opportunity. So the benefit of a short-term rental, again, is you're going to get those same benefits of a rep status, but you don't have to qualify to be a rep. The one thing that you do have to do is meet the qualifications of what we call short-term rental. And unfortunately for many, again, they're not able to qualify for the reps, but they're certainly able to do something such as a short-term rental. And rather than consider the short-term rental as a real estate investment, what the IRS does is they say, hey, we understand that this situation being classified as a short-term rental is not a normal case in which this is a non-passive activity or a passive activity. Rather, if you're making this a short-term rental, chances are you're actively involved. You are more involved with this because you're probably going out to source potential clients or tenants. You are making sure that the property is turned around so that when one tenant moves out, the other tenant can come in and have a clean space. And because of this, this is, in the eyes of the IRS, considered a business activity rather than a real estate investment. And because this is now considered a business activity, you're now able to treat this as such. And this is how you're now able to take advantage of taking these passive activity or passive losses to offset against your non-passive income. So even though the activity is passive, because it is considered a actual business, we now can take those business losses as we identify them to offset them against your non-passive income. So this is the huge takeaway for a short-term rental. And even though the short-term rental is an opportunity to identify losses, again, related to short-term activity, passive activity, because it's considered a business, we're now able to bypass that that rule where you're not able to take passive and offset it with non-passive income. So the key here when it comes to a short-term rental, in order to benefit from this, you have to materially participate. And then secondly, the average stay of your tenants or the individuals coming in to live in your rental, they have to be on average 7 days or less. So it's not necessarily that every tenant needs to be there 7 days or less, but when we take the average of all of the tenants that came in and occupied your space, on average, they need to be 7 days or less. So if you're able to meet that rule as well as you materially participated, then you're in effect able to take advantage of identifying your paper losses. And I'll talk a little bit about the paper losses, but you're going to identify your paper losses to be able to offset your non-passive income. And this is now how you're playing the game of reducing your taxes and playing the tax strategy game so that you can ultimately pay the least amount of taxes. All right, so let me give you a quick example of a short-term rental. And let's say, for instance, we have an individual that goes out and purchases a rental property for $1 million. With some tax planning strategies, they may have involved some specific strategies, such as maybe a cost segregation study. They did some bonus depreciation. And based on that, they were able to identify some depreciation expense in the amount of $300,000. If they take that $300,000 of depreciation expense, and then we compare that to their $250,000 taxable income that they would have earned by way of maybe their business activity. Maybe they had a W-2, maybe they had 1099 income coming in. If we take that $250,000, we in effect can reduce all of that taxable income to zero because we were able to identify $300,000 in depreciation expense on this particular property. And because we didn't qualify for the REPS, but we qualified for the short-term rental opportunity, we're now in a situation where we can come out on top with not having to have any tax liability whatsoever. And this is an example of the benefit of a short-term rental. And again, if you have a REP status, you can achieve the same process, but without having the REP status, you can get the same thing by way of a short-term rental approach. So how do you actually get started? What do you do? How do you actually start saving by way of the short-term rental approach? You first have to go out and get you a short-term rental property. Either you already have an investment property that you can convert from long-term to short-term, or maybe you go out and you purchase you a new investment property. And when you purchase this investment property, you're going to use it for the purpose of short-term rentals. So that's the first thing that you need to do. The second thing is you actually need to materially participate. You cannot necessarily get this investment and then outsource all the work out to someone else. You have to be the one materially participating. You don't necessarily have to do all 100% of the work, but you have to materially participate in this in order to meet the qualification. And then you also are in a situation where you are going to identify paper losses. I mentioned paper losses earlier. Ultimately, what I mean by this is not necessarily taking a loss month after month and not having any tenants to come in to collect rent from, but rather we're going to identify some depreciation on your property so that we can then take that depreciation expense to create the paper losses or the phantom losses. And as we identify these losses, this is now how we're able to reduce your taxable income overall. And then the next thing that you need to do is you actually need to identify a reputable CPA or someone that is experienced with working with real estate investors and employing and implementing these strategies. If you don't have a qualified person or someone that's experienced or knowledgeable about this, then you obviously are not going to be able to take advantage of these specific strategies. So these are the things that you need to be aware of and that you need to be focused on in order to take advantage of the opportunity of a short-term rental approach. And one thing that I will also add is, in addition to the tax savings, when you do involve yourself with a short-term rental, there's a few benefits that you get with this. You're in a situation where you can potentially maximize and increase your cash flow very greatly. And traditionally speaking, when you have a rental, if it's a long-term rental, you're essentially going to dictate a price. You establish that price with the tenant. It may be a 6-month, a year-long lease, and you're pretty much locked in with that. However, when it comes to a short-term rental, you have a lot of leverage and a lot of opportunity to manipulate your pricing. You can change your pricing, and it's not locked in for a long-term period. And more importantly, you have the potential to bring in new tenants throughout the year. They can be seasonal, they can be ongoing throughout the year, and you can play around with your pricing that way. And as a result, your short-term rental could potentially bring you more cash flow than if you had a long-term situation. In addition to that, you are in a situation where you have less wear and tear on your property. Because you do have these tenants coming in on a shorter term purpose or basis, what's going to happen is as they enter and leave, you now have an opportunity to inspect your property. You have an opportunity to identify if there were any damages done to the property, so that if there was, you obviously can fix it sooner than later. And more importantly, it's a situation in which you don't have to have any surprise bills at the end of a long-term lease. So that's another huge benefit. And then hand in hand with that, you have reduced maintenance costs. It's obviously going to be a little bit less, if not more or less, of a surprise bill for maintenance. And again, that goes back to the wear and tear. So these are some of the benefits that you're going to get with a short-term rental. And ultimately, aside from the actual cash flow that you're going to generate, you now are going to be in a position where you can take the tax benefits of something called cost segregation study, identifying depreciation expense using the bonus depreciation approach, and using all of that to circle it up together so that we now factor that into your other sources of income, your other investment vehicles, and ultimately be in a position where you can reduce your tax liability. So this is the conversation for today. This is the topic, the benefits of investing in short-term rentals. Again, if you don't qualify for REP status, your next best bet is short-term rental, and it's just as good without all of the work and requirements that go along with the REP status. If you guys are in a situation where you're a real estate investor that is pursuing a short-term rental, or if you have a short-term rental, but you don't know if you're getting the best advice or if you're not getting any guidance in this particular area, I'd be happy to have a conversation with you. I'd be happy